For most of the trading day, the Indian stock market ignored the mounting economic pressure. Then, in the final hour of the session, the index took a sudden, sharp dive that erased the morning's gains. That late-day collapse reflected a reality already visible at the petrol pumps. Within a single week, fuel prices jumped twice, adding 4 rupees to every liter. These hikes followed the Prime Minister's warnings that global energy shifts require domestic adjustments, a signal for investors to read between the lines. Despite this news, the Nifty 50 index spent hours in the green. The market effectively hit a wall of silence, refusing to drop even as the cost of energy spiked. That silence ended in the final 60 minutes of trading, when the index finally broke its breath and collapsed. This delayed reaction indicates a deep structural bias in how the market is calculated, a mechanism that provided a false sense of stability before the inevitable crash. The Nifty 50 does not represent every corner of the economy equally. It is a weighted index, meaning a handful of sectors possess the mathematical power to move the entire market. 3 sectors currently dominate this balance: finance at 35%, oil and gas at 11%, and IT at 8.5%. On the morning of the fuel hike, the IT sector rallied by 1.25%. Because of its massive weighting, this single sector acted as a temporary buffer against broader market panic. Simultaneously, the very companies selling the fuel, Indian Oil and BCPL, saw their stocks jump by over 2%. Investors bet that higher prices at the pump would protect the profit margins of these oil marketing companies. These heavyweights pushed the entire index upward, even as the rest of the economy prepared for higher costs. This upward movement occurred while global crude oil traded at $110 a barrel, creating a massive gap between index performance and global energy reality. The immense underlying pressure of triple-digit global oil prices was relentlessly grinding against these narrow, temporary sector gains. The rally in IT and oil stocks successfully masked the broader threat, keeping the Nifty in the green while the economic foundation was shifting. The market finally found a reason to pivot when American market futures took a sudden dive during Indian trading hours. As the Nasdaq flashed red, the Indian market finally lost its footing. The external shock from the U.S. tech sector provided the trigger for the local sell-off. This trigger forced investors to confront a difficult reality. A 4 rupee hike is only a fraction of what the energy crisis actually demands. Industry reports from Kotak Equities suggest that a 16% increase, roughly 25 to 28 rupees, is the minimum required for oil companies to stop their current losses. To avoid a total economic shock, the government is introducing these hikes in small increments, attempting to manage civil and economic upheaval. The market drop was the moment traders realized these small, incremental price increases are only the beginning of a much longer adjustment period. High fuel prices lead to higher transport costs, which inevitably show up in future inflation data as the price of everyday goods begins to climb. When inflation rises, the Reserve Bank of India generally responds with its primary tool, raising the repo rate. This makes borrowing more expensive for everyone. The RBI acts as the final institutional barrier, cooling the economy to protect the value of the rupee. Higher interest rates increase corporate debt costs, while making safe, fixed-income investments more attractive than the stock market. The late-day sell-off served as a violent repricing of the market to match a new environment of high inflation and rising rates. The primary constraint on the Indian economy is the supply of foreign exchange reserves required to pay for energy. Because India imports the majority of its oil, every barrel bought at $110 represents a direct drain of US dollars from the national reserves. To preserve these reserves, the government may seek ways to reduce fuel demand, such as encouraging the IT sector to return to work-from-home models to limit daily commuting. The market's current volatility is the system attempting to account for a future where energy is expensive and foreign currency is a tightening constraint.